In this recording, we're looking at the financial market factors in terms of the causes of the global financial crisis. So I've got 5 main factors there, and we need to acquire a little bit of knowledge about each of those and understand the process by which mortgages were given to both responsible and irresponsible borrowers, or I should say good credit risks and bad credit risks, and how that worked its way through the system to the creation of mortgage-backed securities, which then spread risk around the world. So I've got this diagram which explains the securitization process quite well. So right at the top here we have borrowers, and we know that some of those borrowers were prime borrowers and some were subprime borrowers. The subprime borrowers being the very risky borrowers, people with poor credit history, low incomes, people that really should not have been given a mortgage in the first place. Now these people were given, both the borrowers and both the prime and the subprime borrowers were very often in contact with mortgage brokers and also other financial institutions, so mortgage companies, banks as well, and so it's really the banks, the other financial institutions and the mortgage brokers which were giving or negotiating or writing, I suppose, mortgages for these borrowers, both prime and subprime. And you can actually see the relative size of the subprime market here in this diagram leading up to the global financial crisis. So the subprime market is not huge. Over the course of the early 2000s, just eyeballing these numbers, it looks like, and these values are in trillions of dollars, it looks like the subprime market was around about $1.5 to $2 trillion. So it's not huge compared to the size of the total mortgage market or the total mortgages that were written over that period, but certainly large enough to basically cause credit markets to freeze once the GFC had hit. So what we've got here is various organisations writing mortgages. Now, there was then, at the time, an incentive for the people, or let's just call them banks, the banks who wrote the mortgage, to offload those mortgages to another financial institution. So if the bank could actually sell the mortgage to another financial institution in return for a cash payment, the bank was then free to take that cash and initiate another loan on which it would make a margin, as well as fees, etc., etc. It would make money on the mortgage. At the same time, with the advent of these subprime mortgages, there was a very strong incentive for the banks who had written these mortgages to get the subprime mortgages off their books. By that I mean selling those subprime mortgages to another financial institution who was willing to buy them and hold the risk themselves. So by actually having the banks sell mortgages to another financial institution, the banks not only were able to free up some of their capital in the form of cash receipt for the mortgages that they sold and undertake some more lending, but also they were able to move a lot of the risk off their balance sheet. Now the financial institutions that the banks were selling these mortgages to were the investment banks at point 4 here. So the investment banks were buying pools of mortgages. Now here the pool of mortgages is subprime lending, but a lot of this was going on with prime lending as well. So let's just focus, as this diagram has got, on subprime lending. So of the subprime loans, the banks were selling it to the investment banks in Wall Street, and Wall Street were creating a pool of subprime loans. Now those subprime loans still had value. Even though the borrowers were very risky, the subprime loans had value because what was backing those subprime mortgages were the houses. And in the handful of decades leading up to the global financial crisis, housing prices in the United States had always been increasing. So the financial system thought that it doesn't really matter who the borrower is, even if the borrower is a subprime borrower and defaults on the the repayments on the loan, we can simply repossess the house, sell the house quite easily. It'll be worth more than it was today in a few years, so we're guaranteed to get our money back, and we can recover the amount that we loaned, and we can then carry on our merry way. So there seemed to be very little risk associated with lending to subprime customers unless housing prices start to fall. That was the only real risk, and people believe that in the US there was very little chance of that. So now the banks have these subprime loans as well as the prime loans. They were doing similar things with prime loans. They had the subprime loans off their balance sheet. They weren't holding the risk. They were free to lend to more customers. What the investment banks did, however, is, well, they certainly didn't want to hold subprime loans. They're far too risky. So the investment banks started creating these mortgage-backed securities down here at the bottom. And these mortgage-backed securities were a financial instrument that was created and sold off in tranches to investors all around the world. Now, you can't create a financial instrument without it and sell it without it having some value. So when you create a share, it's got some value because you own part of the company. A mortgage, which is a financial instrument, has value because it is backed by the house. With these mortgage-backed securities, they had value because they were being backed by the pool of subprime loans. And even though the market knew that it was questionable subprime lending that were backing these mortgage-backed securities, the market still thought that it was okay because housing prices were always going up. So even if someone did default on their loan, their subprime loan, the house could be repossessed, the money recovered, and the mortgage-backed security would simply be backed not by that house, but by cash of an equivalent amount. So it didn't seem to be too much of a problem. So these mortgage-backed securities were a new product that was created. They had value because they were being backed by mortgages, and the mortgages were being backed by brick and mortar. Now with the mortgage-backed securities, the way they did this is they created different tranches here. The top part of the tranche was AAA rated, so super secure, as secure as US government debt. But then the lower tranches received a lower rating. And so as you move down the tranches, the rating dropped, but the actual return increased. Now what I'm doing here is just giving you enough information to give you a feel for what these products are all about. It's really up to you to go away and read more about mortgage-backed securities so that you're comfortable with them and so that you understand how they contributed to the global financial crisis. So with these mortgage-backed securities, different tranches were created with different risk levels, and the different risk levels appealed to different investors. So AAA were appealing to very low or risk-averse customers, whereas the tranches down the bottom, double B, or even sometimes it was junk bond status, they appealed to hedge funds who were willing to take on high risk for very high returns. Now, once this mortgage-backed security was created, it might have a value of, say, $1 billion. It was broken up into, say, 1,000 pieces, and each one of those pieces was sold off for $1 million. So what you'd be holding is 1/1000th of this mortgage-backed security. It paid a regular payment, and it could be sold in the secondary. It paid a regular sort of interest payment, in a sense, to the holder of the asset, and it could actually be sold in the secondary market as well. So it seemed good at the time. Now, at the time, these assets were paying interest rates that were attractive to market participants, because leading into the global financial crisis, remember, bond interest rates were very, very low in real terms because of the global savings glut, and short-term interest rates particularly in the United States, were very low as well in the early 2000s because of the dot-com bubble bursting and 9/11 in 2001. So interest rates, short and long term, were very low, and here comes a mortgage-backed security paying an interest rate which was above those interest rates. So it was quite appealing from a return perspective for investors. So what we've got here is a process whereby the financial system loaned money to subprime borrowers and then use those subprime loans to create a mortgage-backed security and sell that security off to hundreds of thousands, if not millions, of investors all around the world. And so really it was those individual investors at SIX who were now holding the risk associated with the subprime mortgages. It wasn't the bank that wrote the original mortgage, it wasn't the Wall Street banks, it was the individual investor holding the risk. Now, the big problem with this is what happens if credit markets start freezing. And that is another part of the story that we can get into a little bit later on. Just for the meantime, let's have a look at these mortgage-backed securities. What we've got is these mortgage-backed securities are backed by a pool of mortgages. We've got the senior tranche, mezzanine tranche, and the lower tranche here. And the way this works is that the cash flow from the mortgage payments really service the principal and the interest payments of the AAA tranche first. If there was enough cash flow from these mortgages left over after the AAA investors were paid, it flowed through down to the AA investors, then to the A investors, and it sort of trickled down that way. So really, the only way the AAA investors could lose money is if there was such a decline in the amount of money being paid in terms of mortgage payments that it sort of meant that all of the tranches below them couldn't be paid. Then the AAA people would be exposed to a loss of income. At the same time, they were facing risk in terms of the capital value of the asset as well. So if housing prices began to fall, which people believe just wasn't possible, but if they did begin to fall, then you wouldn't have an adequate pool of assets backing the residential mortgage-backed securities. In that case, the capital value of your part of this mortgage-backed security could actually start dropping in value as well. So there's two risks. There was a cash flow risk and a capital risk involved in holding these residential mortgage-backed securities. Okay, this diagram shows you the difference between residential mortgage-backed securities and CDOs. We already know what residential mortgage-backed securities are. So you've got a group of houses here, and those mortgages, the mortgages on those houses, are used to create another security called a mortgage-backed security. The mortgage-backed security is broken up into different tranches. Now what we've got is a whole pile up the top here, a whole pile of mortgage-backed securities being created. The bottom tranche was very often junk bond status, so it was even very often unrated. The problem, the investment banks and other financial institutions that were creating these residential mortgage-backed securities, they had problems selling the bottom tranches off. Very often there just wasn't enough demand to sell all of those bottom tranches, and they had to sell those bottom tranches. So what the financial system engineered was something called a CDO, and these CDOs were actually created very often using the bottom tranches of these residential mortgage-backed securities. So the person creating the CDO would buy up the bottom tranches of these residential mortgage-backed securities and use those to back the CDO. Very often, in terms of CDOs, student loans, car loans, other types of loans were thrown in there as well. So there's a whole range of different types of securities which were backing these CDOs, and it all became quite difficult to sort of keep track of. So then the CDOs, which were created out of the bottom tranche of the mortgage-backed securities and a whole lot of other sort of risky assets, student loans, car loans are generally quite risky. These CDOs were created using those types of assets as backing. The remarkable thing is that using all of these very questionable assets, somehow Wall Street engineered the top tranche of this new security to be AAA rated. But then, similar sort of problem occurred. As you go down the tranches with the CDO, the bottom tranche is unrated. It's unrated because it's so risky that it's just unrateable. So what they did was they created CDO squares. So right down the bottom here we've got all of these CDOs being created, and the bottom tranches of all of these CDOs are being pulled together to create a CDO squared. And you guessed it, the top part of the CDO squared was rated AAA, as safe as the US government's bonds. So quite impressive how they managed to pull that one off. Now with the credit rating agencies, they were in there very often being paid by the companies that were creating the products to rate the products. So first of all, they had a vested interest in rating these products highly so that the company could sell them off and do well. And the credit rating agencies, as it was determined later after the GFC, once the investigation started, the credit rating agencies didn't fully comprehend what was going on with the creation of all of these structured products, because it looks quite simple here in the diagram, but once you have a look at the product description statement of one of these securities, you'll see how incredibly complex they are. And there are still product description statements of CDOs and mortgage-backed securities out there on the internet, so if you search long and hard enough, you'll find one. And if you have a look through that product description statement, you will quickly understand why the credit rating agencies had such difficulty understanding what they were rating. But still, they went ahead and rated it anyway. Why weren't the regulators on top of this? Because all of this really started to develop outside of the regulatory window. So the regulators were looking at a certain part of the market, and only a certain part, and all of this grew on the outside of the market and developed on the outside of the market, and the regulators weren't even paying attention. The next slide, I've got the monthly mortgage rate resets. Now, if we go back up here, the subprime borrowers, the question then becomes, how were these people enticed, the subprime borrowers, to borrow money? Now, very often these people knew they were approached by a mortgage broker, or maybe approached a mortgage broker themselves, but certainly there are a lot of mortgage brokers going around and targeting people who were struggling, people living in caravan parks or renting apartments. They were targeting them for new loans, and a lot of these borrowers simply didn't understand what they were getting into, the subprime borrowers I'm talking about. So very often it would go like this. Someone would be living in a caravan in a trailer park, and a mortgage broker would knock on their door and offer them a loan, and the idea was that they would take the loan in the form of a mortgage and buy a house. Now, to entice them into that mortgage, very often they were given very low teaser interest rates, and these teaser interest rates were in the range of 1 or 2%. And the length of time those teaser interest rates applied, it did vary, but a lot of those teaser rates were applied to the mortgages for 2 or 3 years. The problem then became, after the 2 or 3 years were over, the interest rates reset up to a higher level, consistent with the risk of the subprime borrower. Now, sometimes the subprime borrowers weren't told this at all, and their interest rates reset, and it was a complete surprise to them. Other times they did read the fine print, or they were told that the interest rate would reset eventually, and a lot of them voiced concern that they wouldn't be able to service the loan at these higher reset interest rates. But what they were told was not to worry. They were told that after 2 or 3 years, once the teaser interest rate period had expired, they would never have to pay the higher interest rate. They were told that housing prices always rise in the United States. They've risen for the last 40, 50 years without interruption. And so after the teaser period is over, after say 3 years, that $200,000 house that you purchased, or apartment, would now be worth $230,000, $240,000. And they were told that given that they would then have some equity in the house, given the new higher valuation, they could go to the bank, they would have some equity, and they could negotiate a new deal because they wouldn't pose such a great risk to the bank because they now have equity. And very often they had no equity before when the loan was originally written. So because they had equity, they could renegotiate a new loan, and it would be much lower, the interest rate would be much lower than the higher reset rate. So a lot of them jumped into this opportunity because the interest payments on the loan were actually lower than the rent that they were currently paying. And it all sounded good. Then we move ahead to this diagram. What we can see here, second on the list, this is color-coded, subprime. In 2007 going into 2008, this shows the volume of subprime mortgages that are subject to the interest rate resetting up to that higher level. So this is the end of the teaser period. And this is 2007, 2008. All of these interest rates were resetting. When did the global financial crisis kick off? 2008. So what we're seeing here is the resetting of these mortgage payments was the trigger for the start of the global financial crisis. So what was happening was that these mortgages were resetting throughout 2007, 2008, and rather than housing values being higher than they were 2, 3, 4 years ago when people had originally purchased their home, housing prices hadn't increased. So these people weren't able to negotiate a better deal with the bank, and they had to then pay these higher interest rates. They had no choice. What a lot of them then did was either walked away from their mortgage if they were in a non-recourse state. That means a state in which the bank can't come after you for your other assets if you default on a mortgage, or if they're in a recourse state where the bank can come after you. And most states in the US are full recourse states. Most people don't realise that, but it's true. Those people would simply declare themselves bankrupt. So what we had, as these interest rates reset up to higher levels, we had a wave of mortgage defaults. The banks were repossessing these houses, and they were trying to sell these houses to recover their original mortgage loan. But of course, housing prices started to fall, and the banks couldn't fully recover the money they had loaned. And as this was happening, housing prices throughout the United States began to fall. And as they began to fall, more and more people began to declare bankruptcy or just walk away from their mortgage. Because a lot of them were getting to a situation where they had say a $180,000 mortgage, and the house had fallen in value to $150,000. For those people, it didn't make sense to continue paying, and they just walked away, which really accelerated the decline in housing prices. Now, in terms of this graph, there's a couple of other interesting types of loans here that were written. Option adjustable rate mortgages and Alt A. They are very similar to subprime loans. and they were resetting throughout 2010, 2011 as well. So right throughout 2010 and 2011, people were still walking away from these Alt A and the Option Arm mortgages. So that's why it took so long for all of this to work its way through the American real estate market, and why real estate prices continued to be incredibly weak right through into 2012 until all of this this mess cleared through the system. So that should give you a bit of an insight into the financial market causes of the global financial crisis. So I've spoken about up here subprime lending. Non-recourse mortgages are mortgages which in which the bank cannot come after your other assets if you default on the mortgage. So that meant that people were just free to walk away from their home. The bank couldn't take their car, couldn't take any of their other assets. The credit rating agencies, they were the ones rating the mortgage-backed securities and the CDOs, AAA, etc., etc. Securitization, we've spoken about that securitization process. That securitization is the process here in which a pool of mortgages is used to create a mortgage-backed security, and then the mortgage-backed security is sold on to individual investors. That's securitization. And then credit default swaps, to a large extent I'll let you read up on that yourself, but basically credit default swaps were insurance contracts that you could buy if you invested in mortgage-backed securities. So an investor could buy a mortgage-backed security, at the same time buy a credit default swap from an insurance company offering this product in the US, and if they lost money on their mortgage-backed security, the insurance company would then make an insurance payment to that investor covering the loss. Now, the insurance industry thought these mortgage-backed securities were a pretty safe bet, so they sold huge amounts of these credit default swaps. When credit markets froze and the value of these mortgage-backed securities fell, then the insurance companies quickly realized that they couldn't pay out all of the claims. And that's when a lot of insurance companies in the US got into serious problems. Okay, one final thing that I want to mention. How did the investment banks get into trouble? Because in terms of this securitization process, it looks like the risk is being held by the investors. So why did so many of the Wall Street banks get into trouble? Well, what happened was there was a wave of foreclosures on housing in the United States starting in 2007-2008. As housing prices began to fall, people started looking